Welcome to another exciting episode of Financial Insights in Minutes. Is economic chaos on the horizon? Today, we'll uncover the harsh truths behind the stock market distortions, gold's explosive potential, and a looming U.S. debt crisis.
Expert predictions of market crashes and geopolitical tensions are shaking tech stocks. You can't afford to miss this.
Subscribe now and stay ahead of the financial curve. Stick around till the end for a summary of the top agreements and disagreements among our experts.
Today we're going to provide summaries of the following videos.
First, Sven Henrich dives into the most distorted business cycle in history. Next, Gary Wagner dissects key technical signals for gold investors. Then, Jeff Snyder argues against the effectiveness of Fed rate cuts. After that, Munster warns of AI-predicted market crashes due to China-Taiwan tensions. Eric Basmajian explores the worrisome state of U.S. debt. Matt from Trade Brigade covers a crucial week for market trends and tech earnings. Finally, Mike from Mott Capital highlights the impact of market rotations on stocks. Welcome to the Thoughtful Money YouTube channel. Today we're diving into a wonderfully complex interview with Sven Henrich from NorthmanTrader.com. Sven offers a surprisingly detailed analysis on what he calls the most distorted business cycle in history. Trust me, you don't want to miss this.
Absolutely. Sven digs deep into the impacts of over a decade of financial interventions and the recent COVID-19 stimulus measures. His insights will have you on the edge of your seat.
So what's at the heart of Sven's argument? What's causing all this market confusion?
Sven's core thesis is that we are in an unprecedentedly distorted business cycle. He points to 15 years of fiscal and monetary interventions, including the massive COVID-19 packages. The result, a market that's anything but predictable.
Fascinating. Let's break that down further. What are the biggest distortions he's talking about?
First off, he highlights that 15 years of interventionism have left a deep impression. COVID-19 measures have extended personal savings, but these have mostly dried up.
Got it. What about his technical analysis?
Sven mentions some intriguing technical indicators. For instance, the NIO oscillator, which measures market breadth, has been acting oddly. Plus, the Russell 2000 saw some dramatic, almost vertical moves. Totally wild stuff.
Yikes, sounds unstable. What about specific market levels?
He's keeping an eye on the S&P 500 reaching a critical level, the 1.618 Fibonacci retracement, which has shown strong resistance. Other key charts and technical levels also point to potential shifts in market sentiment.
Interesting. How do current valuations factor into this?
Current valuations are extremely high. We're talking about a market cap to GDP ratio exceeding 200%, a figure that spells trouble when economic fundamentals are disconnected from market valuations.
So is he making any immediate moves in the market?
Yes, he's moved to cash and is very cautious about testing new long positions. With the VIX spiking, which often signals upcoming corrections, he's treading lightly.
All right, time to break out that crystal ball. What predictions did Sven make?
Sven estimates we might see a market correction of about 10 to 15%. However, he cautions that this might not necessarily mark the end of the bull market. Additionally, he warns that the market might be overestimating how soon and how much the Fed will cut interest rates.
Wrapping it all up, what should we take away from Sven's analysis?
Sven urges investors to stay cautious and prepared for increased volatility. He points out that the current market behavior doesn't align well with economic indicators, which means it's no time for complacency. Stay vigilant, folks.
Welcome to Kitco News. Today's hot topic is gold prices and the technical signals every gold investor should watch out for. We have the brilliant Gary Wagner guiding us through the latest trends and what they could mean for the future of gold.
Absolutely. This one's going to be pure gold. Let's dive into Gary's insights and see what treasures we can uncover.
So what's the main gist of Gary Wagner's analysis? What's the golden nugget here?
Gary dives deep into the recent sell-off and consolidation in gold prices. He's looking at market behaviors that hint at big future moves and emphasizes understanding these signals is crucial for any gold investor.
All right, let's break down those key points, starting with the market behavior. What's happening with gold lately?
Gold's been in a week-long consolidation following a sell-off, showing a head and shoulders pattern. There's a significant compression triangle formed by lower highs and equal bottoms, suggesting potential for a powerful breakout. It's like coiling a spring before it pops.
And what about the recent profit-taking and corrections? We've seen some hefty numbers.
Indeed, we're witnessing profit-taking after gold hit a psychological resistance at $2,500 and recorded the highest intraday value in history at $2,488. Corrections could be shallow or deep based on market support levels.
Gary's technical approach sounds like a multi-tool of strategies. Tell me about these technical signals he uses.
He combines Japanese candlestick patterns, Western chart patterns, Elliott wave theory, and Fibonacci retracements. These tools help him time entry and exit points in the market, while fundamentals drive the larger market movements.
All right, let's fast forward and peek into the crystal ball. What does Gary foresee for gold prices?
Gary predicts gold might climb to $2,700 by early 2025 based on Elliott wave analysis. Key support levels to watch are $2,375 and $2,400 for further price actions.
How could the Federal Reserve's actions impact this?
Great question. Powell hinted at an upcoming interest rate cut, which could further stimulate gold prices. It's like adding fuel to the fire for these gold market moves.
So wrapping it all up, what should our viewers take away from this?
Gary underscores the importance of recognizing key technical signals in the gold market, especially those critical support levels and chart patterns. He's bullish, with significant price increases by next year. Keeping an eye on Federal Reserve actions will be crucial for investors navigating the golden seas ahead.
Welcome to Eurodollar University, where we dissect the financial world's most pressing issues. In today's episode, Jeff Snyder tackles the big question on everyone's mind. What will happen when the Fed finally cuts rates?
That's right. Jeff takes us on a historical journey to prove that rate cuts are basically the financial world's version of a placebo. Spoiler alert, they don't work.
So, what's the main argument Jeff is making here?
Simply put, Jeff argues that rate cuts are a superstition. They don't actually deliver the economic benefits folks are led to believe. And he's got the receipts to back it up.
Let's dive into some of those key points. What's the mainstream narrative on rate cuts?
The mainstream belief is that when the Fed cuts rates, it's like a magic wand. Lower borrowing costs, more home and car purchases, accelerated growth. Sounds dreamy, right?
But Jeff says that's pure fantasy?
Exactly. He goes into detail about how past rate cuts didn't prevent recessions or lower unemployment. Take the 1981-82 recession. The Fed slashed rates dramatically, yet unemployment soared. Quite the Cinderella story, minus the fairy godmother.
And this isn't a one-off thing, is it?
Nope, the same pattern repeats in the 1990-91 and 2000s dot-com recessions. Rate cuts, higher unemployment, rinse and repeat.
Wow, tough crowd for rate cuts. So what's Jeff's ultimate point here?
He calls rate cuts a superstition. They were a makeshift policy invented when the monetary system evolved beyond the Fed's control. Just think of it like using a Band-Aid for a broken leg.
And this whole Fed policy is more psychological than actual monetary policy.
Exactly. Jeff backs this up with statements from Alan Greenspan and Milton Friedman, showing the Fed targets interest rates to maintain public confidence rather than influencing real economic factors.
So what's Jeff predicting about future rate cuts?
He predicts they'll be just as ineffective. History has shown it over and over. Rate cuts won't save us from economic downturns.
Wrapping it all up, what's Jeff's advice?
He advises everyone to take a hard look at the evidence. Rate cuts are based on superstition, not facts. Relying on them is like counting on a rusty horseshoe for luck in an economic storm.
Welcome back to David Lin's YouTube channel. We've got an intriguing discussion today featuring Gene Munster from Deepwater Asset Management. Buckle up because we're talking AI predictions, market turmoil, and some spicy geopolitical stuff.
Oh, it's going to be a wild ride. Gene dives into how AI models foresee China invading Taiwan this year and what that could mean for tech stocks and the broader market. Let's get to it.
All right, let's cut to the chase. What's the big takeaway from Gene's talk?
Simply put, AI models are predicting a high probability of China invading Taiwan by year-end, which could send tech stocks plummeting. Buckle your seatbelts for some market turbulence.
So, what's been causing the recent tech market decline?
A mix of political news. Trump suggested Taiwan should pay up for defense, increasing invasion concerns, and Biden is talking tougher trade sanctions, which spooked the markets.
Geopolitics influencing tech stocks. Tell me more.
Absolutely. Taiwan's key role in chip production means any disruption, like a Chinese invasion, would heavily impact tech giants like Nvidia and Apple. It's like pulling the rug from under Silicon Valley.
How reliable are these AI predictions anyway?
Gene's team asked AI models about various scenarios for 2024. 2 of the 4 models bet on a Taiwanese invasion and a whopping 35% drop in Mag 7 tech stocks. Scary, right?
And what about the US trying to catch up in chip production?
Not happening anytime soon. Even with new plants in Arizona, the US won't significantly reduce reliance on Taiwan until at least 2027. The road's long and rough.
All right, crystal ball time. What else do these predictions entail?
Geopolitical tensions could cause major volatility, especially for tech stocks. Remember, AI suggests Mag 7 might drop by up to 35% by year's end. And Munster sees a 3 to 5 year AI bubble with periodic pullbacks but overall growth. Hold on tight.
So what's the final word from Gene Munster?
Against the backdrop of heightened geopolitical risks and AI-driven predictions, Munster underscores the importance of strategic diversification in chip production. It's a call for caution as we navigate these bumpy economic waters.
Welcome back to EPB Research on YouTube. Today's topic is a real hot potato, the U.S. debt crisis. We're diving deep into why our national and private debts are soaring higher than a kite. Ready to get into the nitty-gritty?
Absolutely. Our guide today is Eric Basmajian, the brain behind EPB Research. He's breaking down everything you need to know about America's debt dilemma, from sky-high public debt to private sector burdens. Fasten your seatbelts.
All right, spill the beans. What's Eric's main argument in this debt saga?
The core thesis is that America is drowning in debt, both public and private. Eric points out that while the private sector has deleveraged a bit, the public sector, especially the federal government, is shouldering a massive and growing burden.
Let's get into the numbers. What's the situation with public debt?
Public debt has shot up from $28.4 trillion in July 2020 to nearly $35 trillion today. If this trend continues, we'll hit $43 trillion by July 2028. That's a 23% jump in just 4 years.
How do these numbers compare to the past?
From 1955 to 1980, total debt averaged 150% of GDP. Today, it's more than doubled. Compared to 2007, where federal debt was 41% GDP, today it stands at a whopping 106%.
But hasn't the private sector deleveraged a bit?
Yes, total private sector debt is down to 233% of GDP from 209% in 2007. However, business debt remains highly leveraged, while the financial and household sectors have deleveraged significantly.
Any specific sectors we should be really worried about?
Oh, definitely. Multifamily mortgage debt has surged to 8% of GDP, the highest in U.S. history. This sector is fraught with overbuilding and potential bad debt. It's a ticking time bomb.
And what about us, the consumers?
Household mortgage debt has fallen sharply from 72% of GDP in 2007 to 46% today. However, consumer debt, think student loans, auto loans, credit card debt, remains stubbornly high.
Eric had some predictions to make, didn't he? What are we looking at?
Indeed. First, he expects public debt to keep ballooning, worsening fiscal strains. Second, this unmanageable debt will likely lead to a reduced standard of living for the average American.
And what about the multifamily real estate sector?
Eric sees significant risks there. The sector's overbuilding and potential bad debt could spell trouble for both corporate and non-corporate business sectors, as well as regional banks.
So, in a nutshell, what's the final word on this debt crisis from Eric?
Eric emphasizes an urgent need for strategic debt management. The focus should be on mitigating risks in the overleveraged multifamily real estate sector to prevent further economic distress.
Welcome to Trade Brigade's Weekend Update. Today's topic, it's do or die for the markets this week as we dive into major tech earnings and some crucial economic indicators. Stay tuned because Matt has some golden nuggets of wisdom for us.
Absolutely. We're at a major crossroads with the S&P sitting on a knife's edge and the NASDAQ weakness still very much in play. Plus, the PCE inflation numbers are coming out this Friday. If you're looking for market insights, you've come to the right place.
Let's cut to the chase. What's the main takeaway from Matt's analysis on Trade Brigade?
This week is crucial. We have major tech earnings and key economic indicators like the PCE inflation numbers coming out. Matt emphasizes focusing on the market structure and price movements to navigate through this volatility.
Got it. So let's break it down. What's going on with the market structure and technical analysis?
The S&P closed at a critical support level last week, indicating sellers are in control. The Nasdaq, too, is showing significant weakness. Matt identifies key levels that could either provide support or lead to further downside.
And what about the earnings and economic indicators?
We're about to get earnings reports from the major tech players, part of the Magnificent Seven. Their performance is expected to significantly impact the market. Plus, the PCE inflation numbers coming out on Friday could add more fuel to the volatility fire.
Sounds intense. What trading strategies does Matt recommend in such a volatile market?
Matt suggests being cautious. He talks about potential for counter-trend moves, but advises using multiple technical indicators like Fibonacci levels, volume profiles, and anchored VWAPs to identify crucial support and resistance levels.
All right, let's get the crystal ball out. What predictions does Matt make?
Firstly, the market reaction to tech earnings will be vital. Strong earnings could lift the market, while any significant misses might deepen the current weakness. Secondly, high PCE inflation numbers could increase market volatility, potentially pushing the market below key support levels.
So, what are the big takeaways?
Strategic caution is the name of the game. Keep an eye on major tech earnings and PCE inflation numbers. Use technical indicators to navigate the potential volatility. This week could set the tone for the market's immediate future.
Welcome back to another action-packed episode of Mott Capital's Market Chronicles. Today, we're delving into the video Massive Market Rotations Squeezing Stocks, where our host Mike takes us through some fascinating market dynamics.
That's right, Mike's got the lowdown on what's been moving the needle in the market, focusing on small-cap stocks and some juicy financial sector details.
So what's the big idea behind all of this? What's been shifting the tides in the market, according to Mike?
The big takeaway is that significant movements in small caps, specifically the IWM ETF, were driven by changes in the yield curve and the behavior of regional banks. This resulted in a gamma squeeze, spiking stock prices.
Let's break it down then. First up, what's the deal with the IWM small caps rally?
Mike kicks things off by highlighting a big move up in IWM, spurred by the CPI report from July 11th. The yield curve's upward trend started around the end of June, hitting close to 0%, which was great news for regional banks.
All right, and how did the yield curve play into this?
As the yield curve steepened, it meant better times for regional banks, which form a sizable chunk of the IWM ETF. Regional banks began their upward journey in mid-June, and this trend gained momentum post-CPI report.
Interesting. Now, tell me more about this gamma squeeze phenomenon.
The gamma squeeze happened when demand for call options skyrocketed, driving up prices. We saw rising implied volatility, falling skew, and call volume going through the roof. Short sale volume spiked too, adding more fuel to the fire.
Seems like things got pretty chaotic. What other market dynamics did Mike discuss?
Mike pointed out that regional banks and tech stocks had an inverse relationship. As regional banks, tracked by KR ETF, rose, tech stocks, tracked by XLK ETF, declined. This theme might persist, especially if the Federal Reserve starts cutting rates.
Looking ahead, what does Mike predict for IWM and regional banks?
If the gamma squeeze doesn't make a comeback, IWM is likely to lose some gains and stabilize at lower levels. But if the yield curve continues to steepen, especially with potential rate cuts, regional banks could keep climbing.
What about the tech sector? What's in store?
The tech sector might take a hit if regional banks continue to rise. The money flowing into regional banks is diverting from tech stocks, so tech could stumble while banks benefit.
So, in a nutshell, what are Mike's final thoughts?
Mike wraps up with a reminder to watch the yield curve and its effects on regional banks and tech stocks. The IWM surge from the gamma squeeze might not last, so keep an eye out for Federal Reserve actions. Stay tuned for more updates.
Sven Henrich warns about an unprecedented market distortion. while Gary Wagner sees gold shining bright amid chaos.
Jeff Snyder challenges the effectiveness of Fed rate cuts, and Gene Munster highlights geopolitical risks with AI insights.
Eric Basmajian paints a grim picture of U.S. debt, and Matt from Trade Brigade talks about a crucial week for market performance.
Lastly, Mike from Mott Capital uncovers market rotations impacting stocks. While they all agree on heightened market volatility, they differ on safe assets and the severity of upcoming corrections. Stay tuned for more financial insights.
Thanks for watching Financial Insights in Minutes for July 21st, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.